Well, we're happy to be joined by CJ Zygadlo today for our podcast, The Giving Current. CJ is the Senior Tax Manager for Carr Riggs Ingram, and they have offices in Tampa and Clearwater. And CJ, you've been a CPA for a little over 30 years, and you've also worked for nonprofit organizations and served on boards. So to start out, what got you interested in being a CPA in the first place?
Probably security. A nice solid answer. Yeah. And I kind of woke up one morning in high school, there was no Google, and said, oh, maybe I'll get an accounting degree. And my guidance counselor was like, that sounds great. And my parents were like, perfect. And so it was my original degree, and I just kept going with it. Yeah.
Nice. To know that in high school and carry that through. That's great.
Yeah.
So we're just rolling out of tax season. How are you feeling?
I'm feeling grateful that it's over. We're in the recovery phase.
Was it a particularly trying year for?
I've always described tax season. Each tax season is like its own hurricane season. So you might have a named storm that ends up not having a lot of damage, or you might have one they're all similar. Your prep is the same, and your recovery is the same, but the intensity and where it hits, who it hits, it can vary. So
depends on what new legislation might be out there.
I mean, sometimes.
Or if you get a delay.
Oh, those are the worst.
Yes.
Worst. Thankfully this year we were right on target. So
you've done lots of different types of work in the accounting field and done audit work before, but now what kind of clients do you work with now?
Mostly high net wealth individuals, and I do a lot of work in the trust and estate space. That's probably where the majority of my time is, but I do have some younger entrepreneurs that I'm working with who are really scaling their businesses, which is exciting to be a part of.
So what are those types of clients tend to be worried about these days, tax-wise?
I think always the paying of tax. Not that there isn't cash to pay the taxes, but am I paying too much? Am I doing anything that the IRS would consider would not feel great about, wanting to stay away from those areas? I work with a fair amount of people that are in transition from losing a spouse. And that's an interesting tax transition on a lot of fronts. You may be now filing trust returns. You are transitioning from being married, filing joint usually, to single, and a lot of implications, and where have the assets gone? And I think in those cases, it's a lot of, I just want to get this right. And it's not even like that they weren't involved in the tax process when their spouse was alive. It's now the landscape has really shifted. So they need a little bit more support.
Do you find that a number of clients, both on the estate and trust side and things that people have set up, or maybe the businesses that you might work with, or individual clients, do you find many of them are pretty charitable?
Yes. I think this is a very charitable area. I find. I've always been pleasantly surprised.
So working on you've been inside nonprofits before, but then you also, from a CPA standpoint, work with clients, and many of whom are donors or want to be charitable. Is there anything you wish either nonprofits or the donors themselves understood before making financial decisions or charitable giving decisions?
I think a lot of it, anyone on a nonprofit, whether the leader or head of development, needs to understand all the ways that someone can donate, so that when they're having conversations with donors and potential donors, they can clue right in to, oh, well, this is a great opportunity for maybe this part of our mission or this new program, or we're going to have a capital campaign coming up and could really use your help. I think anything that the nonprofits can do to understand their donors, what phase of life are they in, what is important to them. A lot of what donors are doing in terms of legacy planning or incorporating charitable organizations into their trust and estate, the organizations don't know until the people pass. So there's always that kind of like, I know that organizations really like the opportunity to thank people while they're alive. But some people are private and don't want the attention maybe. It's a dance. Everything about this, I think, is a dance.
That's a good way to describe it. I think it's been interesting to watch sort of on that side of it, on the donor client side, and see. I've worked with a number of folks that I wish they would tell the nonprofit. They're talking to us, so clearly there's a charitable inclination there, and they're deciding what they want to do with their giving, or have already decided and are working with PCF to kind of structure what that looks like. But many times they don't want to tell the nonprofit, and it would be helpful to dig into that a little more. Some people I do know it's because of the uncertainty. They don't want to tell an organization something that might not materialize,
or that might change,
or could change. And some of it I do see is not anonymous, but they don't want anyone to be talking with them, changing their mind maybe, or while they're doing that. But I have seen in a very positive way those who are very upfront with charitable organizations. They built a relationship with the organization. They're very transparent that this is what our plan is. Could change, but that builds an opportunity for the donor to learn so much more, or tailor their gift to something that might be even more meaningful to them inside an organization, or find ways that their gift could, the impact of it could be maximized instead of just, it comes later.
And it is something that I try to ask our clients that are leaving something to a charity in their estate. Do you want me to reach out to the organization and let them know that you've done this for you? Because donors might feel weird to say, oh, by the way, I'm leaving you $300,000 in my will. It seems a little like braggy. So I'm happy to do that for people. And I encourage them to do it, because for the charity to know how much this client, has already thought about them and invested in them, I think it's important.
I think it's important. I think people may be driven by not wanting a fuss to be made.
Yes.
I mean, that's the feedback I've kind of gotten from people I've talked to, that were amping up, like going from maybe $1,000 or a $10,000 annual contribution to mid six figures, close to $7. And, I'll ask, do you have a relationship? We can put you in touch with someone. They'd love to hear it. And maybe there's something specific you'd like to a part of the mission you'd like to support specifically, or maybe there's a name you'd like to honor in conjunction with this. And I think that isn't, sometimes it's met with, oh, I hadn't really thought about that. And sometimes it's no. But I think what they're also missing out on, and I understand very much the please don't make a fuss, but also it's good feedback for the organization. Like, what are we doing that resonates with you so strongly that you're shifting your gifting? And
that way they know their campaigns are working. That way they know their relationships are working. And then that fuels them.
And which part of the campaign and which program did we implement, or have we reinvested in? What speaks to you, donor?
And a lot of times when those gifts actually materialize, the people who initiated them, the development directors or CEOs are no longer with the organization,
Right.
because, by the time somebody passes away, and so there's never a connection, of like, I did that. Yes. It worked.
Right. I mean, there's certainly always gratitude on the
Yes.
part of the organization.
Absolutely.
But the relationships that everyone's working so hard to establish and cultivate and maintain and grow, those have shifted. And so there is something lost there.
So on the side of looking at, there have been changes this year, obviously, in the tax environment. But I think one thing that hasn't changed is the value of giving appreciated property to charities, appreciated stock, or other appreciated assets. And how often do you have to help clients understand the value of that?
It's something we certainly talk about a fair amount. It depends on how consultative clients want our relationship to be, not just compliance-based. We prefer to be consultative. I kind of going back to what I've said before, the folks that know about the value of donating appreciated assets are donating that Berkshire Hathaway stock every year.
Yes.
And so it's also the relationships we develop where we're understanding what the underlying assets of someone's wealth is, of their estate, what will be in their estate, and part of managing the taxability of that, potentially trying to mitigate that, trying to make sure that the personal people in those folks' lives are well cared for in the way, and how do we also most tax efficiently or elegantly support the organizations and missions that are important to you. So that's also a dance.
I wish that more donors, and we do our part to try and educate people about the value of giving appreciated property. And I think there are a lot of advisors out there in different fields that try and help their clients understand that. It always surprises me the number of people we still run into that it takes some convincing. I think still writing a check is easier, and it really isn't necessarily easier. I mean, if you have a easy relationship with your broker, then you can call and ask what stock to transfer. And so I don't think it's necessarily harder, but maybe even a little extra work can have a outsized benefit for donors, and some of them may even give more over time, realizing there's an even more impactful
But they
tax
forget,
benefit.
even people who donated stock,
Yes.
sometimes they'll say, oh yeah, I should be donating stock. Like, you have to have the conversation with them multiple times.
Yes.
Right. Well, when you write a check, that's money that's been taxed.
Yes.
You're sending previously taxed income. When you donate a stock, the growth, which is what you're trying to keep out of your capital gain calculation
Yes.
each year, is untaxed to you.
Right.
And that's, the nice, one of the nicest tax strategies is not bringing something into income in the first place.
Right.
So you're getting the benefit of a deduction, you're helping a charity, and you're not bringing that potentially large gain onto your tax return.
Right.
So on that note, explain bunching and like how a donor could use a donor advised fund to sort of save themselves a bunch of taxes.
So bunching is when you really look at all the elements of what you can itemize, because folks don't always itemize every year. And it depends, a lot of the big ticket items are significant medical, which tend to happen later in life. Mortgage interest, property taxes, charitable contributions, things like that we're typically used to kind of gathering that information and giving it to your tax preparer and CPA. The thing about that Schedule A is that every single section has a limit or a haircut The SALT, the state and local tax deduction, never had a cap until the Tax Cuts and Jobs Act. So since 2018, that's been capped at $10,000 a year, which is where we don't have a state income tax in Florida, but if you own more than one home for personal use, oftentimes that number would be higher. If you have a lovely home, one home with that you weren't homesteaded on when you moved here, your taxes are higher. And the higher so that's been capped at 10,000. And that's when we really started having those more aggressive kind of bunching discussions. Now with the new tax bill, it can go up to 40 as a cap, but if your income is above, say, $500,000 or $600,000, you're back down at that 10,000 anyway. So we're still back at the bunching discussion. So bunching really is a way of saying, I know I have these expenses. The one thing and those are kind of year in, year out, your taxes, your mortgage interest. My charitable giving is what might swing me to itemizing or not itemizing. And the beauty of the donor advised fund is that you get the deduction the year that you fund that DAF. And then you can write checks from it as you see fit, but you get the deduction in the year that you put the money in the donor advised fund. And if you maybe took an every other year approach of, say, $20,000 instead of 10 per year, you might find yourself saving money on taxes in the years that you funded the DAF, as opposed to, oh gosh, I'm so close to the standard deduction or to exceeding it, but I'm stuck with the standard every year, which is pretty high. It's higher than it was before 2018, but still, it's where you have control.
And you can even add more benefit to that by using appreciated stock or property to fund your donor advised fund, avoid that capital gain, and then get all the benefits of bunching. For sure.
Yes. And that way you're not overloading one charity too. You could also just write a very large check to a charity. But is that exactly what you want to do? Do you want to slowly give it out to do you want to invest that money, let it grow? And
and I think a donor advised fund also has the benefit of, it's something you can talk about with your family. Like, we put this money aside. What are our family values? Here's what's important to me. Have you considered this? Because it might be something that your kids manage after you're gone.
And I always think philanthropy is passed down through the generations. And that's a great way to bring the kids into the conversation. What charities are we going to give to? Let's look at these. You pick one, I'll pick one.
The kids are always listening and they're always watching. And my own young adult children have surprised me a lot.
Are they charitable?
Yeah, and even just how they identify. We were adopting a dog when my daughter was in high school, and she was going to be in charge of the dog. And it was a lot. We had a lot of paperwork to do and a lot of references that we had to provide. And she had to write an essay and, also provide video of our backyard and still photos of the house. And she started the essay with, "We are a family that believes in education," and then went on to talk about our love of animals. And I said, "Oh, that's really interesting. Why did you say that?" And she goes, "'Cause we are." And I said, well, she was in high school. And I said, well, what does that look like from your perspective? And she said, well, that's where you and Papa donate your money to your alma maters, to the scholarship funds. And you're always telling me that your grandmothers went to college. Both of my grandmothers went to college. And she goes, not a lot of people can say that, that are your age.
Absolutely.
And I was like, wow, okay. And then, on my son's side, we had lost a family I grew up across the street from. Both of the parents died within a year of each other in the last couple of years. And my kids over the years have become very close with with my friends, and my son said, "Oh, which charity at home did you contribute to in honor of Mr. and Mrs. So-and-so?" And I was like, "Oh." I said, "Who'd you contribute to?" And he told me, and I said, "Oh, then I'll do the other one," or something like that. But I was like, I was so involved in the emotion of everything that happened. I wasn't thinking longer term, and it was nice. It was really nice to have that reflected back to me.
Yes.
Good job, Mom.
Yeah.
They're listening. They are watching.
They are always listening and watching.
Yes.
Yeah.
So, as any good CPA, I'm sure you would love your clients to do things earlier and earlier, plan, and we hear the stories trying to help clients plan ahead. What suggestions do you have? Especially there is behavior about year-end giving, and both Meg and I have been in the nonprofit world, and lots of giving comes in the fourth quarter of the year. What
85% or something is the statistic.
Wow.
Yes. What kind of suggestions do you try to share with clients, or would you share with others that helps with that should be done earlier in the year?
Well, maybe addressing first, if you do leave it to the later moments, use a donor advised fund. You get that deduction, and then you can calmly decide where you want it to go. Pre-planning, I don't know if you're planning on bringing up QCDs, but QCDs from your IRA, which you can start making at 70 and a half. So you can start making those before you're even required to take a distribution. And that is that elegant donation that never comes into income. So it's not even part of your potentially itemizing. It's it won't affect your Medicare premium, which sometimes when people haven't needed to take a distribution from their IRA prior to becoming 73 or 75, that additional income can really change other things on their return, including how much they're paying for Medicare. But the QCD, qualified charitable distribution, you arrange with whoever's the administrator of your IRA, and they make directed donations from your IRA to the charity. You don't receive the check and then turn around and send it. It is done without the taxpayer as the middleman.
Right.
And that accomplishes a couple things. It'll help maybe drive your RMD down if you can, because you can do over $100,000 a year. It can really be quite impactful. In terms, some people like the last minute, so
Yes.
that's okay. If you want to think about things, I urge you to go out and learn about your community, and who do you have your eye on? Who do you want to know more about? Nonprofits want to tell their story. They want you to reach out, and maybe you want to start with a little bit of volunteering and see if you'd like your dollars to follow. Sometimes it's the other way around. I think we can't really change our natures. We can only work with them as best we can. Yes. So not everyone wants to know what to do in advance.
Yes. It's hard, and some of us are very deadline motivated. So December 31st or April 15th, whichever
Nothing makes me more productive than the last minute.
That was literally my college roommate and I. She was my fellow accountant, and that was our study motivation. And we still quote it to each other on the regular.
Yes.
I will be calling her on the way home and saying, someone else knows our trip.
Yes.
Well, one thing though is QCDs can't be used to fund donor advised funds.
Right.
So sometimes people don't know a charity but they know they need to make this distribution and they want to do it charitably. One thing that we have is a fund that sort of finds the needs in the community and
great.
Then grants them out, with operating grants for 2 years. It's the Helping Pinellas Now Fund.
Well, that's good to know.
Yes. So donors who either maybe are not 100% sure about something that they want to do, or maybe they've done some charitable giving during the year and don't necessarily want to use a RMD or part of their RMD to also do other charitable giving, but it makes sense to turn that into a QCD, can use that opportunity. But also donors who want to benefit a number of charities all at once. And so there are those people out there that instead of giving to all these different organizations, have an opportunity to give to a fund that benefits a broad swath of the community and have broad good done in the community. The QCD, though, helping people understand the power of giving through QCD, more people are picking up on that now. And I think it's the changes that now are becoming the regular changes with the increased standard deduction. And as we also have an aging population, more people are getting a good understanding of QCDs, but there are still many who haven't yet learned the value of that. And it is a great way to give, especially if you're not going to itemize or don't think that you're going to itemize. It's a powerful way to still get pretty much the same benefit that you might have gotten before with a charitable deduction, because you just don't have to count the income, which is pretty great.
Yeah, and when you look at the assets that they own when they die, the least tax efficient thing to inherit is an IRA, a traditional IRA.
Yes.
So if you are,
I didn't know that.
Yeah, well, because it's money that's never been taxed. And oftentimes people inherit them when they themselves, the beneficiary, are at their highest earning years. So now you're just adding more. So, it's not a dollar for dollar inheritance. It's that dollar less the tax on that dollar, which, over 30% for a lot of folks makes it less efficient. It makes all of your income subject to higher tax also.
And in that too now are the requirements to spend that or have it liquidated to the beneficiary within a period of time. And it's not like you can just stretch it out, as or
10 years
continue
usually. I mean, that's a lot. A $1 million IRA, that's $100,000 a year while you're probably still working. Can be a significant income to an individual and put you in a whole different tax world. Yes, which in some ways is good, but also I think parents who are trying to help their children or wanted their children to inherit things like that also don't want to just shove them into a whole nother tax bracket while also trying to make something of value for them. There's more tax efficient ways to give to beneficiaries, and use that as an opportunity to give to charity is often a good way to do that. Either before you pass away, while you're doing QCD gifts, or to leave that actually to a charitable organization or several charitable organizations. Named as beneficiaries. Nonprofits aren't paying tax on it. So
it can be a very powerful gift. Those sometimes are very large gifts to organizations, and much more tax efficient to go to the charity than to your children or grandchildren.
Do you ever work with charitable remainder trusts or encourage your clients to go that route?
That's really a team approach, I find, for the encouragement. It's a financial advisor, it's a trust officer, it's an attorney, it might be the community foundation and the CPA. And
isn't it great if you get a client who wants their team to talk?
Yes. And that's really the only way I find to really be efficient in what we do and to really support people in these big decisions. I work on a lot of charitable remainder trusts that are already in place. I have a couple clients that are doing, that's also a dance. And it's because you essentially lose, if not control, the feeling of control over those assets. There's a lot of tools available for folks, but it asks them, taking advantage of them, asks them to really think about their assets, their wealth, their planning in a different way. And we haven't all reconciled ourselves with the assets we do have. I think, there's a lot of our feelings about money from growing up, or how we grew up is different than our circumstances now. That all kind of comes into play when you're talking about advanced planning. And it's important, and I'm sure you guys see it, that we meet people where they are. If they would like to move forward in any direction, it's super helpful to just know kind of where they are.
Yes.
And what their feelings are about it.
Yes. It's another good planning tool also for next generation too. Mm-hmm. But it does take the understanding of the mix of assets that you have, mm-hmm. what you want to accomplish with that, how you want that to be going to different generations, what you would like to be benefiting charitably later, and then the other players in the picture. And we've had experiences, and I'm sure you do too, where people come and they just want the simplicity. Well, can't you just draft that document for me? And there aren't templates for that. And when we don't pull them out, we're not lawyers here at the Community Foundation, but you need a lawyer to draft a trust agreement for you for that. You need people to help you plan what the best assets in the right time to put that into a charitable remainder trust. When it all works well, it can be a very powerful tool. Mm-hmm. But it takes a lot of awareness of yourself, your family, your needs, and bringing together other advisors around the table. And if you don't have those other advisors, then people like you are very helpful to get people, introduce them to people on the other side that do the other things to put something like a charitable remainder trust together.
Yeah.
So as a CPA that works with clients who might have complex businesses or high net worth, can you share with us maybe some myth versus reality? Everyone is scared of the IRS audit and is worried about that, which is a great reason to work with a CPA and skilled tax preparers for sure. But from your experience and career, do you have any sort of myth busting around the infamous IRS audit?
I haven't seen anything really surrounding significant donations, and maybe hopefully I'm not willing that into existence. Significant donations are really easy to support. And it's not that the IRS can track from what you've listed on your tax return to the actual entity, but they also have that organization's 990, where you're probably listed on Schedule B, which isn't part of the public disclosure copy of a 990. But so there's less, it's not a hard thing to substantiate. Mm-hmm. So certainly when you donate stock, appreciated stock, you have that information from your brokerage account, your financial advisor. You have an acknowledgement letter from the entity saying thank you for that 1,000 shares of Apple, and so on and so forth. So, and it's tracking that transfer is easy. Cashed checks, large cash checks, easy. So in terms of the reasons for an audit, I don't see that as the highlighting reason for one. Mm-hmm. Oftentimes you may be audited for something else, or if they start pulling the thread and they just want to have more things substantiated, you might have to, but those records exist, presuming they're actual donations, which they should be. I encourage everyone. So there are other types of things that trigger full audits more than charitable giving.
Mm-hmm. And any suggestions, and you talked about some of the things that are necessary in substantiating the gift, and things like giving appreciated stock is pretty easy to track. What if it's other types of property that you might be giving? What are the things that donors are going to have to make sure that they have in line before the gift is made, generally?
Right. Sometimes an appraisal, if it's art or a large boat or car or home, If you're donating closely held stock, which is a great tool prior to a sale. Prior. Because before you kind of put yourself up on the auction block for a sale, you can value that stock, have a business valuation done. And that's not appraisals of specialized assets and a business valuation, which is of its own specialized asset, a closely held business. They're not cheap support to have, but to have it is a way of audit insurance. It's also just an establishing basis in things. It's important.
And for some of those hard to value assets, it definitely is going to be what helps you figure out what's deductible in the first place.
Right.
If you don't have that, you don't really, the IRS doesn't like any of us, taking a shot in the dark, trying to figure out what it might have been worth. They really get kind of wonky about that. But it's money worth spending, especially if you're going to be giving a sizable gift of something that is not readily, the value is not readily ascertainable, like, stock that regularly trades on our stock exchanges and has a daily valuation.
And also you want to make sure, just if you're donating something a little outside of what organizations typically receive, does it coincide with their gifting policy?
Yes.
Is what you're trying to give them, does that fit in what they can accept?
Mm-hmm.
Because I think depending on the size of the organization or whatever, whoever that organization reports to is beholden to, there are certain things they might not want to take on. What are you guys seeing in gifting policies regarding digital assets?
So there are a lot of questions, I think, of nonprofit organizations, because there are more and more donors who want to give digital assets, cryptocurrency, and we have had some come to us and ask us what our policy is, and at Pinellas Community Foundation, our policy allows for the acceptance of that, and we have a process for accepting, quickly liquidating, and usually also for us, cryptocurrency, that for our own internal evaluation purposes, separate from what the donor has to do, but for our own internal evaluation, things that trade daily, regularly, or by the minute, being able to get our own internal values for that. But some are still worried about it, and because it's pretty easy to get a crypto wallet and to get set up on an exchange so you can liquidate, but that's a whole new thing. It's not the common thing that organizations understand. Like, you go to a bank and you open a bank account and there's paperwork and everyone sort of understands how that works. And so I think it's not just the gift acceptance policy and whether or not you can accept crypto and your policy allows for that or not, but also the surrounding pieces of, if we're going to do that, what else do we have to have in place? It's an opportunity to work with the community foundation, or there are also other entities that help on both the donor evaluation side and liquidating that and then sending you a check for the proceeds. So some organizations have gone that route and just get a check for that. But I think it's still, even though we've had crypto for a long while and a lot of people understand what it is, how you get it, how you get rid of it, is still a mystery for some organizations. And so there's work to be done there. But at Pinellas Community Foundation, our gift acceptance policy is pretty liberal. And because we have a lot of resources at our fingertips also to liquidate things or deal with, if you had to hold something for a while and we agreed to accept it, we have a whole process. But if we agreed to accept something, we can hold it for a while if we need to before it sells, because it could be a home and that might not, and then what are you going to do? Get an agent? And so for some smaller organizations, those sort of non-routine gifts are challenging to accept, but it's certainly worth reaching out to folks like us to ask, and is this something you could work with us and our donor on to accept this?
Even accepting stock. I mean, we have people who want to donate stock to an organization and they don't have any way of accepting
They don't
it.
have a brokerage account.
Right. So, and then the donor doesn't want to liquidate the stock to send it.
Right.
So they send it through us and we can then.
Oh, that's a great help.
Yes.
Yeah.
And then, some organizations do have their own brokerage account. Others don't, or they don't receive a lot of stock gifts. And so why do we have this account sitting on here? Or if it's not used for a couple of years, then the institution often will close the account. And so we have easy ways to make that possible for organizations, among other types of gifts that could be given, and then have great advisors to help with some of that work and working with the donor too on what their side is. The other piece with some of these sort of non-traditional, I would say, and for some of us it is traditional, but the period you need to hold the asset sometimes matters for what the donor can deduct, or what you sell it for as the charity. You receive some type of donated something that's maybe not stock, and you sell it quickly because you want to get rid of it, and you sell it for way less than the donor thought it was worth, or that it might have been worth, and you sell it for far less because you just want to liquidate it and be done. I don't want to be holding whatever it is. That can have some implications for the donor, the tax deductibility of the gift for the donor too. So it's important for donors to be clear with the organization, and for the organization to be clear. Is our policy to liquidate this as quickly as possible, or do we have the capacity to hold it for a few years, or is it something we can use within the mission of our organization? And all of that has implications for what the donor can deduct, and so just clear communication, I think, is really important.
Yeah, for sure.
So talk to us about working with Pinellas Community Foundation. What is it like to work with PCF or any community foundation, but especially us? And why would advisors want to do that?
It's a dream.
That's nice.
I really, really appreciate your knowledge of the landscape of Pinellas County. It's very helpful to have your boots on the ground, as well as a 10,000-foot view of what the county needs, what the county is going to need, who the players are, who should be connected, because a lot of us that are in advisory roles, while we try to get up here as much as possible, there are periods of time, like tax season, where we're very, heads down, pencils up. And so that push-pull of, I want to know what's going on, that's not my job, and that isn't my career. So I'm grateful that it is yours, because there's just so much historical knowledge, future thinking knowledge, just understanding how everything fits together. And the pressures that nonprofits are under, where the opportunities are. I see you always playing the long game, with a lot of short games also happening at the same time. We all have a lot of plates in the air, but I just think you're an excellent resource for the community.
Thank you.
Yeah, thank you.
And so as part of what, we talk about charitable giving on the Giving Current podcast. We talk about charities and community needs, and it runs the gamut. One of the things that we have started to do as part of our own charitable giving and recognizing your time spent coming to talk to us is to give a donation to a local organization in your name, thanking you for your time. Oh. What organization is on your mind today that you'd like to support? We'd be happy to do it.
Dunedin Cares, the client-focused food pantry in Dunedin. They're a wonderful organization. The need is greater than ever. Full disclosure, I am on the development committee. But they're doing really good work, and they have a great team.
They do.
Yeah, a really strong board, a wonderful executive director. So,
and that need is really growing.
Yeah, for sure. And I don't personally see it reducing anytime soon. So,
Well, we're excited to make a gift in your honor.
Thank you.
so much for your time today.
oh, thank you
This
for
is
having
fun.
me.
It's been great to talk to you, spend time doing this, and we should do it again.
Yeah.
Sign me up.
Thank you.